Greetings, everyone. Welcome to the FTE's webinar on COVID-19 Economic Implications and Policy Response. It is now 6 p.m. Eastern Daylight Time, 3 p.m. Pacific Daylight Time, and we will begin recording the webinar. As part of the Foundation for Teaching Economics efforts to promote excellence in economics education, I'm pleased to present this online seminar looking at COVID-19 and its economic implications and policy responses. I'm Ted Tucker, Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Professor Scott Baier. Professor Baier is the chair of the Economics Department at Clemson University. From 1999 to 2012, he was a visiting scholar at the Federal Reserve Bank in Atlanta, and from 2007-2008, he served as a senior economist on the President's Council of Economic Advisors. Professor Baier's research interests include the causes and consequences of globalization, the economic impact of free trade agreements, and economic growth. Professor Baier has been a longtime economics instructor in our Economics for Leaders program, and we're grateful for him giving today's presentation. Following this talk, we will have about 10 minutes to answer questions, and we will post a recording of the webinar on the FTE website. Please use the Q&A features to submit questions following the presentation. And following this webinar, we ask that you complete a short evaluation form on today's presentation. So I'd like to turn it over to Scott now. Scott?
Hello, everybody, and thank you for taking time out of your day, afternoon, or your evening for this presentation. So I'm going to go through kind of more of a heuristic view of trying to understand the economics of COVID-19. And so I'm going to apologize in advance for any technical glitches that come up. There always inevitably something comes up, but I think we should be able to follow along pretty easily from the presentation. So let me find my slides here. And slideshow. Okay, so again, the starting point, I guess, is a little bit different starting place to begin than I have in the last few times I've given this lecture, is if you were paying attention to the news today, what you saw released was the GDP growth rate for Q1 of 2020. So this is the first 3 months of this year, and the drop in GDP in this first quarter of 2020 was, in some ways, was an eye-popping minus 4.8%. And to put that into context, you know, COVID-19 only impacted the economy the last 2 to 3 weeks of March. So looking at those last few weeks, it had a dramatic impact on overall quarterly GDP growth. And as I'll come back to a little bit later, and so we could put this in some context, how big of a drop this was. If we look at the biggest drop that we had for the year during the Great Recession, that was a little bit over 2.5%. So this minus 5% drop in GDP growth for this first quarter of the year was quite dramatic, and we probably will expect, well, we do expect Q2 GDP growth to be even lower. So before I talk about what's coming down the road, let's go back and look a little bit in the rearview mirror and try to understand how quickly how this all evolved. So again, the early COVID-19 timeline can kind of be traced out like this. Back in December 31st, the first case was detected in the Hubei province. Roughly, 23 weeks later, the first case outside of China was detected in Thailand, Japan, South Korea, and the US, even though now we said the US first case may have been a little bit earlier. On January 31st, the White House limited travel, international travel into the US. On February 9th, the death toll in mainland China exceeds SARS. And on February 11th, the WHO names the new coronavirus COVID-19. So this is basically a month and a half in. At this point in time, most economists, in fact, I went to the National Association of Business Economists conference at the end of January, and there was some talk about how COVID may impact the economy. But most of the talking then was at this point, it was mostly believed that the coronavirus would largely be contained within just a few countries and have limited impact on overall economic performance. So again, why did we think that? Well, again, we just thought that it was believed that COVID-19 was largely contained within Asia. In particular, we thought most likely it would be contained within China. And then its features or its impact on the global economy would mostly come through supply chains, through manufacturing. So if you look at, say, China, roughly 30% of China's economy comes from the manufacturing sector. And that manufacturing sector in China is also linked to the US and Canada, France, Italy, Spain, and Japan through outsourcing and these other supply chains. So if something gets shut down in, say, China, that will disrupt the supply chains and then slow the manufacturing process in other countries. So again, it would have an impact on the world economy, and you'll keep seeing these countries come back up through my talk from time to time. The reason why I bring these countries up, because these are the countries that are most frequently talked about when we discuss the novel coronavirus or COVID-19. And if you just add up these 8 or 9 countries, they roughly add to about 60% of world GDP. So what we were expecting to occur was a modest impact of coronavirus occurring through supply chains, and that would slow down supply chains, slow down manufacturing, and have knock-on effects in the US. So again, the original thought around the end of January, early February, was if it was just limited to supply chain disruptions, it would knock about 0.25% off of GDP growth or 0.5% off of GDP growth, lowering the baseline prediction this year, saying GDP was going to grow at about 2.5%, lowering that down to 2%. Well, as we know, the coronavirus wasn't limited to just a few countries. And so a way to see the timeline now, is I'm going to show how things quickly evolved, is rather than show a timeline, I'm going to look at financial markets and see how financial markets reacted to progression of coronaviruses as it moved through other economies. So what I did here in this chart is I took the Dow Jones and the S&P 500 and I benchmarked them to be equal to 100 at the beginning of the year. And so as you could, what you want to think about here is movements away from 100 represent percent changes in the Dow Jones and the S&P 500 at any point in time. So why do I use this? Well, one, because we think the stock markets are forward-looking in the sense they're predicting what's going to happen to the economy down the road. So what we can see are there are a few key dates where things start to play out where we know that that COVID-19 is going to impact the U.S. economy potentially in a very major way. So kind of the first shot across the bow came on February 24th. On February 24th, we saw the largest fall in the Dow Jones Industrial Average in 2 years. Now, there were two reasons that people thought were causing the Dow to fall that much. One was COVID-19, the fears of COVID-19, and the second was a weak retail sales report. Again, all we can observe is the fall, and most economists and financial experts at the time couldn't tell what was causing the bigger fall. Was it due to the fears of COVID, or was it due to the weak retail sales report? Then on March 9th, what we saw was the COVID cases in the US exceeded 500, and that led again to a very, a dramatic fall in the Dow Jones Industrial Average. Again, now that we've seen the cases go from relatively small to over 500, again, started to send worry signals that COVID-19 would be a major health event in the United States. And I think the next big day came on the night of 3/12 into 3/13, March 12th into March 13th. And we saw another quite dramatic drop in the Dow Jones Industrial Average. And this followed a press conference held that night by Donald Trump, as well as the NBA postponing its season. The next day, midday, the NCAA postponed its tournaments. and the Major League Baseball pushed back its schedule. So this sent a signal to, I think, every market participant, oh, these large events that we have come accustomed to going to are no longer going to occur. And again, our lives began to change in the economy again. We knew it would be much the year. 2 days later, it was a Friday, White House and Congress independently discussed some type of fiscal rollouts or fiscal policy that were going to be used to help address both the economy side and the health side. And what we saw then was the market take a tick back up. So what we've been going on in the sense since this time period is a little bit of a roller coaster ride, where the stock market has been going up and down. And if you saw what happened today, I believe the Dow rose by more than 500 points or 2% on news again that there may be some of the treatments for COVID-19 seem to be having some positive outcomes. So again, responding to that, hey, look, down the road, things may be better. The Dow Jones is a predictor of future market activity or economic activity, took a bounce up today. Now, to move from talking about financial markets to talking about the real side, I'm going to talk a little bit about the epidemiology. I think what we've all become is a little bit more familiar with epidemiology than what we've liked. And I'm going to kind of present it in two quick ways. Is one is, oops, I'll skip this one for time. Is how we typically model, or epidemiologists typically model or think about how disease spread, is what they believe what is true is that there's a section of the population that's susceptible to a disease. They become exposed to this infection when they run into an infected person. So think about what can occur randomly is someone who is susceptible runs into or encounters someone who has the disease. They become infected, exposed, later infected, and what eventually is going to happen is either they're going to recover or move to some other state of the world. Now, in most cases, how do we treat this? Well, we treat infections with some type of remedies, vaccines, prophylaxis. But with the case of COVID-19, we had nothing like that to do. So once you're exposed and moving to infected, there really was no option for policymakers or healthcare practitioners to do. So the only real thing, the only action that we could do on the health side was to address this health, what I'll refer to over and over again as a health shock. The only thing that we could do on the health side to keep the society healthy was this notion of social distancing. And if we keep people from running into each other, bumping into each other, then we prevent the susceptible people from running into the infected people, and we can slow the disease down. Again, we have to do this because we have no vaccines, no other treatments, no other prophylaxis that can help those people that are exposed, infected. So the only choice we had from an economy standpoint was this notion of social distancing. And this notion then of social distancing means we're going to potentially spread out how quickly people become infected, even though the total amount of people infected may not be changing. And so this is the idea of what we've all seen by now of what is meant by flattening the curve. So again, we've all seen graphs that look something like this. So, this bell-shaped distribution, this normal shaped distribution represents what would happen if we didn't have social distancing. The blue-shaped curve represents the slowing down of the spread of the disease if we have social distancing. So what are the big concerns about social distancing from both an economic standpoint and a healthcare policy standpoint? What we're worried about is the healthcare capacity of the economy. That is, how many ICU units do we have? How many ventilators do we have? How many beds, doctors, and nurses do we have? If we don't flatten the curve, if we didn't flatten the curve, and the number of people infected exceeds the healthcare capacity, clearly the mortality rate will go up. So one of the ideas about flattening the curve is making sure that the number of people, or trying to ensure that the number of people who are sick or over and above the healthcare capacity looks a little bit more manageable. A second important thing that economists talked about, and we talked about this early about flattening the curve, was it also pushes the peak of the curve out to the right. So in most of the models I've worked at looking at how the disease spreads, this shifting the peak of the curve out to the right means we don't reach the peak till almost 2 months after you would if you did nothing, if you did social distancing. Why is that important? Because we know from an economic standpoint, people respond to incentives, and there is the incentive then, both on economic and on humanitarian side, is to increase the healthcare capacity of the economy. So one of the things that we hoped would happen if we could flatten the curve was also to see a rise in healthcare capacity. And certainly to a certain extent, to a large extent, we've seen this occurring in the areas that have been impacted the most. We've seen hotels converted to hospital bed places to stay. We've seen ships come into the harbor that hold more people. We've seen increase the capacity of the ICU units, and we've had doctors and nurses move to those locations. So in these areas that are heavily impacted, we've seen an increase in the healthcare capacity. Now, the way we relate this to kind of the economics is an important way. So now what we're doing, we're thinking above the graph here are the number of cases that are the people that impacted. Below the graph now we want to think of how bad a recession will be. If we did nothing in terms of social distancing or anything, what we would likely see is a recession that mirrors the lack of social distancing or just letting the disease play out. What we would have a high rate of infection, a relatively high mortality rate, and this would push economic activity down. And so we would naturally go into a recession just by the cause of it. The impact of social distancing, however, is going to have quite a bit different effect. The effect of social distancing is likely to lead to a much deeper recession, and it could lead to a more prolonged recession. Again, what is the idea of social distancing? It means we stay more or less isolated from each other. If we stay more or less isolated each other, we're not going off to the market and buying goods or services. This is sometimes referred to, you'll hear it talked about in the news or by academic economists or sometimes by politicians, it's a sudden stop of demand. Households and firms no longer are going out in the numbers that they were buying the goods and services they were. So there's been a big drop off in demand. So now what we've done, and thinking about things, kind of tying the front end of the presentation together with the back end of the presentation, yeah, there are supply side channels in which COVID-19 is impacting things, breaking up supply chains. So you have supply side effects. But now we're seeing where the biggest effects are occurring on the demand side. So you have a real drop or a reduction in aggregate demand from the idea of social distancing. And so what we can see now here is that there is a real trade-off in the sense of, by practicing social distancing, we are saving lives, but also by practicing social distancing, the economy is going to go into a much deeper recession than it would have otherwise. And so again, let's think about why there's going to be these sudden demand stops. So here we are again looking at this same group of countries. And the big reason that we're seeing this fall off or a big drop in GDP for lots of these economies is because the service sector is a large share of total production. So in the US, services are almost 80% of US GDP. And so most services that you or I, say, consume or buy requires face-to-face interaction. And so what we're doing is dramatically reducing that face-to-face interaction. So we're pushing down GDP quite a bit. And again, when you look at the share of services in all of these economies, whether it's the UK, US, Canada, Spain, even China, which we think is this large manufacturing economy, more than 50% of their GDP comes from services. So economists have looked at what are the most vulnerable industries and sectors. The most vulnerable industries and sectors are the entertainment sector, food, recreation, health, beauty, education, social assistance, and manufacturing ends up to be very sensitive to this as well, because a lot of manufacturing relies on services that support manufacturing. So if you add all of these up, these account for more, just this small list accounts to more than 50%. Well, let's see how this manifested itself in the data. So this is data that's was put together called home base, and they record hours, different industries. And so what they did was they looked at how much people were working in January and early February in these different industries, and then what happened to the amount of hours they were working as COVID and COVID fears spread through the economy. And what we could see here clearly from mid-March to the end of March, there was a precipitous drop in hours worked in almost all of the service industries. So if you look at beauty and personal care, they were down almost 90%. Food and drink was down over 70%. Leisure and entertainment down nearly 70%. So what we had, and again, this is visualizing in some ways this idea of a sudden stop. People stopped consuming beauty and personal care, stopped going out to restaurants, stopped going to movies, stopped going to concerts. So you didn't need those workers in those industries. So you had a cutback of 75 to 90% in lots of these industries. And what we're seeing now toward the end is a little bit of a tick back, but we're still down below 50% in most industries. A way to see this kind of as a point in time, if we look at where we were a few weeks ago, hours worked in beauty and personal care were down 90%. Leisure, and think of movies and concerts, down almost 80%. Transportation was doing better, and home repair was doing a little bit better, but still down minus 45 to 40%. So this sudden drop in demand led to this dramatic cutback in hours worked. Another way to visualize this is through what's called weekly new claims for unemployment. Last week, so this is the data series that comes out weekly. Unfortunately, from an economic standpoint of view, most of our important data come out either monthly, like unemployment, or quarterly, like GDP. We don't get weekly statistics or hourly statistics. Weekly unemployment claims are the closest things we have to something that's telling us, you know, what is the shape of what's the labor market like. So last week, so tomorrow, if you tune in at 8:30, you'll hear the new weekly unemployment claims. So turn on CNBC or something like that. Last Thursday, more than 5 million people, so this data is in thousand, more than 5 million people filed for new unemployment claims, or that they were recently unemployed. And this is a 4-week streak now, in which in middle of March, 3.3 million people lost their jobs and filed for unemployment. The next week, 6.8. The week after, 6.6 million. And last week, it was 5.2 million. You add those up, that's 22 million people that have lost their jobs. So within the course of a month, we've gone from an economy that was around 4%, 4.5% unemployment, to an economy that's around 10 to 12, heading probably to 15 to 18% unemployment. So it's a quite dramatic swing in less than a month's time. And again, to put this in perspective, these last 4 weeks just are so much bigger than anything else that we've ever witnessed. The largest increase in unemployment claims we've had going into the last 4 weeks occurred during the midst of the Great Recession, in which 1 week we had 665,000 new claims for unemployment. So what we've seen in the last 4 weeks is an order of magnitude larger than the biggest number that we've ever seen. So again, how things have changed here in the last 4 weeks is something, you know, that I have never seen or experienced as an economist. And again, to put a little bit of perspective, I was working in the Bush administration during the Great Recession. And the Great Recession, for those of you who remember, really played out over the course. It started in August of 2007. Bear Stearns failed in 2008. We had the Lehman collapse in September of 2008. And then we had TARP in September 2008. and then the auto bailout, and then President Obama's stimulus package in 2009. So again, thinking about this, that was the Great Recession that played out over the course of a year and a half. This COVID-19 has played out in the course of just about 4 or 5 weeks. So again, the dramatic fall like this, we haven't seen it in any time in my lifetime. Even the Great Recession didn't have numbers that look like this. And so again, now I take the same group of countries where I reported their share of world GDP, manufacturing share, and I've added in the number of deaths and the number of confirmed cases. Now the U.S., as you can see, they dwarf almost all the other countries, both in terms of confirmed cases and confirmed deaths. But again, one thing you should always do is put it in context of the size of the population. With the exception of China, the U.S. Has a much bigger population. So again, we should always think about scaling these a little bit to the size of the population, not just thinking in absolute numbers. And oops, that's I added this column today, and this column came with a typo, so that should be GDP growth. So what I've added now to this is the forecast of GDP growth that's occurring in these economies. And what you can see, again, with the exception of China, and China usually has 8 to 9, 10% GDP growth. Almost all developed economies that are listed in there are going into a quite severe recession this year. So this is the forecast GDP growth for 2020. And we can see for the US, we're expected to contract at about 6%. Canada over 6%, Italy 9%, Spain 8%. Again, to put this in perspective, the biggest year of contraction we had during the Great Recession was the U.S. contracted in 2009 by about 2.5%. So again, this is much bigger than anything we saw with the Great Recession. Forecasters remain a little bit optimistic that coming into 2020, that will start to bounce back and have somewhere between 4 to 4.5% GDP growth in 2021 and after. So this last slide was designed to help think about kind of what economists often do is think about cost-benefit analysis. So this is an uncomfortable decision because you're choosing between really two bad outcomes. One, we have no containment strategy, so you don't think of any social distancing. And the other strategy is stringent containment policy, some type of stringent containment policy like shelter in place and social distancing. So again, what we want to do is we want to think about what are the trade-offs here. So clearly, with no containment policy, you're going to get some reduced economic activity. You're likely to have large coronavirus deaths. So some of the estimates were you would have somewhere between 600,000 and 2 million deaths if the U.S. didn't do anything. And there would still be some non-coronavirus deaths. With stringent containment policies, what you're going to do is what we're seeing. You're dramatically reducing economic activity. You're likely to have fewer coronavirus deaths, and you're also likely to have more non-coronavirus deaths. We have a question mark here because sometimes in mild recessions, death rates actually fall because there are fewer traffic accidents because people aren't driving as much and fewer accidents at work. But when you have much deeper recessions, what typically happens is the death rates will go up because those people with low incomes are the ones that are more likely to lose their jobs. They're also likely to have more compromised health situations. So the loss of income and their health status, they may end up having long-lived health outcomes. One of those could be death. You're likely to have increase in suicide rates and increase in other activities that may lead to higher deaths. So again, if with stringent containment policies in deep recession, you're likely to have more non-coronavirus deaths than you would otherwise. So economists are trained, and this is maybe one of the reasons why we're called the dismal science, is because we have to think about, given that we only have two bad outcomes, which is the least bad of these two, right? There's nothing I can do at this point and wave my hands and say everything's better, we have a vaccine, everybody can go back to work. It's how do we weigh these two different outcomes? So again, the analysis of containment policies say, what are the economic impacts of reducing economic activity, and then what is the value of additional deaths? It's a complicated equation, both numerically and philosophically. The way we have to do it is the economy is priced in dollar terms. So we talk about GDP, that's in dollars. The philosophical thing that some people outside of economics have trouble grappling with is, in order to make it an apples to apples comparison, we have to put something like a value of life on a value for an economic life. And so a back of the envelope calculation of doing this cost benefit of analysis is on the economics. We come up with a way, whether we're comfortable doing it or not, it's kind of what we have to do. There's a range of the statistical value of a life. Kind of the average range is between 7 and 14 million per statistical life. In some ways with COVID, it's argued that these people, the people who have been dying, have lower life expectancy. So again, to shave things against kind of social distancing, I'm going to even give a lower value of economic life, say it's only 5 million rather than the range of 7 to 14 million. Again, picking another number on the low end, that 600,000 lives are saved rather than the high end of 2 million. We can think of the value of lives saved as roughly 3 trillion. Also, we know that the people who are recovered, many of those have long-term health issues associated with a compromised respiratory system. So if we think there are 2 million people roughly that survive, if we didn't have a containment strategy or social distancing, 2 million people would survive. We place their health value at about 500,000 per person. So what we do is we add those up and come up with a total benefit of social distancing of roughly about 4 trillion. On the cost side of the shelter in place or the lockdown or the social distancing, we know that we could actually put a value on lost economic activity every year, and that is because every year has a different amount of work days, and this variation in the number of work days tells us if we're not physically on the job, if every day was like a Saturday or Sunday, what is the lost income? So if we look at the second quarter, there are about 70 lost work days in this quarter, plus we add in the few days in March. So the cost of a lockdown in terms of lost economic activity, that ends up being roughly $1.3 trillion. So when we look at this cost and benefit, assuming that there aren't any additional non-COVID ID loss from the shelter in place, what we see are the benefits from shelter in place or the benefits of social distancing exceed the cost. So if you ask, almost any economist, academic economist, most academic economists would say that the value of social distancing is greater than the value of, say, of getting the economy up and running, at least at this point in time. So a way to kind of capture this notion is the University of Chicago has a panel of economic experts that are economists at Chicago and economists at other top universities. And they ask questions all the time. And they had one that was a series of questions that was related to COVID-19. And the question was, a comprehensive policy response to the coronavirus will involve tolerating a very large contraction in the economic activity until the spread of infection has dropped significantly. So if you look at these numbers, most economists agree that yes, it seems like it's the right thing. 88% of economists either agree or strongly agree that the shelter in place, at least at the point in time when this question was asked, or the social distancing was the right thing. And if you weigh it by their confidence in their response, it goes up to 97%. There was no economist that strongly disagreed or had no opinion. So again, this is capturing the idea that most economists believe that the social distancing was an important aspect in terms of or what should be done weighing that higher than the loss of economic activity. The next thing I want to think about is thinking about what the policy response should be. The policy response is to make sure we understand that this time it's really different. Both the Great Depression and the Great Recession started as a financial crisis which spread to a collapse in demand. Moreover, in some sense, these were there were imperfections or intended consequences that occurred in the financial market that were induced by how we wrote our contracts. Again, these were man-made disasters that started in the financial sector and then led to a collapse in demand. For those of us who are old enough to go back to 1975, the big drop in economic activity we had in 75 was due to oil. It was an oil crisis, and that was due to a large, sharp rise in the price of oil, which occurred from a contraction in the supply of oil. So again, this was a group of producers that decided not to provide as much oil to markets, and they pulled back that amount of oil. It slowed down economic activity. But once again, a shock that is in some sense induced by the activities of individuals interacting in the market. Key thing here is prior to this pandemic, none of the above was true. The financial markets were in very good shape. Banks were well leveraged. They were doing well. Real GDP growth, while it wasn't going through the roof, was strong, robust, buoyed by strong consumer confidence, consumer spending. The unemployment rate, as we know, was quite low. Oil prices were falling. So when people look back and talk about 2008, 2009, they often refer to the economy as the Goldilocks economy in the sense of the porridge was just right. Real GDP growth was hovering about 2.5%. Inflation was low and unemployment was low. And again, kind of the sweet spot of where we had been. So again, what we had was a well-functioning economy and then a shock by nature, a health shock, that impacted the public health side. And so what this health shock needed was a cessation of economic activity. So I think an important thing that I want to stress and kind of not on the slide here is it doesn't do any good, or it's not the right way to think about the fiscal and monetary policy response as a Keynesian response or a classical response, or a term I don't like to use at all, as a fiscal stimulus. Because as we normally think of the term fiscal stimulus, what is occurring is you're trying to stimulate the economy by getting people out to spend more money to get economic activity going back, going back up. In this case, we don't want people to run back out to the store and increase economic activity. What we're trying to do is we're trying to support the financial side for households, and also support what you'll say, and I believe it's the next side, is the relationship between employer and employee. Again, the economy was doing very well with low unemployment. We want to keep the matches between employee and employer. So again, what should the government response be? I think most economists also agree with this statement. The government response is you respond first to the impacted sector. This is a health shock. The first thing that we should be addressing is how to deal with this health crisis. We can't move on to a healthy economy until we move, at some point, move past this idea of a crisis on the health side. Second thing we should be doing is provide income support for lower income and the most vulnerable people. And again, as I mentioned, as I was going into the side, is support to maintain employer-employee matches. So again, that just means, look, most people like their job that they had, and the employers like most of their workers. Let's try to do something so that we keep those employees matched with their employer. Then another aspect is to provide some support for the sectors that are most exposed to the shock. So again, quickly looking at the fiscal timeline, I'm going to walk through this very quickly. First response came March 6th, a small expenditure of $8.3 billion that was mostly designed for R&D and public health. The Family First Act was 314. Again, you'll see this on the next slide. This act was mainly designed to impact the health side. Phase, what I'll call now 3A, was the CARES Act. This was addressed to impact the economy. And phase 3B was providing more, again, adding on to what the CARES Act did, because we quickly went through all the money that was. So we talk about phase 2, phase 3A and B very quickly before I move on to Fed policy. So again, phase 2, the Family First, was addressing the health crisis, the health shock. So what they did was free testing for anyone whose doctor recommended testing. Again, why did they do it this way? Remember, going back to this time period, tests weren't widely available, so everybody couldn't be tested. So it had to be the doctor recommended. Second and third thing they did was expand family and medical leave and paid emergency sick leave. Well, why did you do this? Especially for low-income families, there is some tendency to say, I don't feel well, I need the money, so I have to go to work, and then by going to work, you're exposing more people to work. Or my son or daughter is sick, I can't afford to stay home with them, so I'm going to take care of them at night and then head back to work. So what by expanding family and medical leave and paying sick leave, what that allowed the families to do was, if you had someone in your household or yourself who wasn't sick, you should stay home and take care of those individuals, so it decreases the spread of disease. They increased the unemployment benefits, and then they provided food assistance for those income categories who are going to be mostly impacted. So again, you can clearly see that this act was targeted at hitting the health side by making sure that, one, you got tested, and two, if you were sick or someone in your family was sick, you stayed home with them and so more or less quarantine yourself. Fiscal policy, phase 3, was again to provide income maintenance. So we had the $500 checks or $1,200 checks for households. The small business loans, this was the Paycheck Protection Program, or PPP. That was $350 billion. It was to employers that had less than 500 employees, and it's designed to cover 6 weeks of payroll. Key thing about this is that if you use that Paycheck Protection Program money to maintain payroll, then you were able to write off, in many instances, all of that loan. So again, the idea, and this was something novel to fiscal policy at this time, it was designed to keep employees matched with their employer. Then there's the Economic Stabilization Fund, or the Main Street Lending Program. And this was designed for medium-sized firms, also to provide support for state and local municipalities and some targeted industries, say air carriers and firms that were important for national security. So that covers what the fiscal side did. And again, notice much of this is not a fiscal stimulus. It is income support and support to maintain employer relationships, trying to keep employment as high as it could possibly be, and to expand unemployment benefits. So let me quickly now go through the Federal Reserve timeline. And these slides will be available. So you can kind of work through these and walk through these, or the presentation will be available. What we saw on March 3rd, Fed does what it always does when it sees some crisis occurring, is that the Fed cut the federal funds rate. On March 15th, they noticed things were getting worse, so they cut the federal funds rate even more, and then undertook a bunch of economic activities that the Fed typically does when things slow down. 3 days later, what we saw the Fed do was re-implement or reinstitute many of the programs that were started during the Great Recession that we haven't used since. Those were started back up. About a week later, what the Fed did then started undertaking even more aggressive activities that they've never done before. And then on April 9th, they were given the authority to work with the Treasury to help implement the Paycheck Protection Program and the Main Street Lending Program. So again, let me kind of go through this very briefly so we could see what the Fed is doing different than it normally does. So again, normal operating procedures, the Fed, they did these all on March 3rd and March 15th. They cut the federal funds rate, told member banks, if you want to borrow from us, come borrow from us, lowered the reserve requirement to 0, and then used forward guidance saying, hey, look, this is what interest rates are today, short and long. We're going to do everything we can to keep the interest rates as long as we can, setting market expectations. After they undertook these procedures, what the Fed noticed, and the best way to capture this is this picture, or one way to capture it, is U.S. Treasuries are what's referred to as a safe haven. When the economy starts to go bad around in the U.S. or around the world, you want to move into safe assets. U.S. Treasuries are a safe asset, so people want to start holding these safe assets, so people start buying Treasuries. If you learn from your one of the things you may have learned in your Principles of Economics class, bond prices and interest rates are inverse related. So when there's an increase in the demand for bonds that pushes up the bond price, it has the effect of pushing down interest rates. So what we saw late February, early March was this movement into the safe haven as bond prices were falling, as more and more people demanded bonds, pushing up the price of bonds, lowering interest rates. Around the time of March 13th, March 14th, into that date that's circled there, interest rates started to bounce back up. This was started to say, uh-oh, Treasuries aren't such a safe place. People are trying to cash out, get cash as best they can, and they started noticing this in across all different asset categories. So what the Fed did then, following this around March 15th, it said, look, what we see is everyone's trying to cash out of all different type of assets, whether it be Treasuries or money market mutual funds. What the Fed did then was they said, we're going to provide as much liquidity to the market as they can. So on February 15th, the Fed started securities purchases. They don't call it quantitative easing, but again, this is quantitative easing. They're buying back mortgage-backed securities and Treasuries and providing cash to the market. So again, when you buy bonds and you buy mortgage-backed securities, the Fed is doing it with cash, so they're injecting cash into the system. So this is providing liquidity, and the whole goal of this, as you can see in the top banner here, all of these actions done by the Fed were to ensure financial market stability. Second thing they did 2 days later was they reinstituted the primary dealer credit facility. This is when they start, what I mean by this, or what the Fed means by this, is they start lending and borrowing and buying bonds and mortgage-backed securities from dealers that they normally don't borrow from. And so these are large investment banks. So again, providing liquidity to investment banks. They also then reinstituted what's called the money market mutual fund liquidity facility. And what they noticed is that firms have money in money market mutual funds, and they were all trying to cash these out. And what the Fed was doing, say, hey, we're going to step in here and then provide additional funds, additional liquidity in this market. Also, to the banking system, they increased the amount of overnight loans that they were making to banks, again, providing liquidity in short term and medium term to the banks in ways that they weren't doing it before. So again, these actions were similar to everything that they did during the Great Recession. And what we saw going back, we had that run to safety that I depicted before. There was that cash grab, and then's when the Fed increased all of these activities to provide liquidity, and it moved interest rates back down. So again, here's where the Fed stepped in and tried, again, to ease financial markets, saying, hey, if you're demanding liquidity, one of the things the Fed can do is we can inject cash into the system. Now, something that's completely new to the Fed is, in what they haven't done, is this notion now that they almost can lend directly to firms. So they created the primary market corporate credit facility. Now the Fed can lend directly to corporations. So if a firm issues a new bond, it used to not be the case that the Fed can go in and buy these bonds. Now they can. So the Fed can lend directly to firms. They instituted the commercial paper funding facility. Anybody who's run a small business, medium-sized business knows a major way in which you fund day-to-day operations at a firm is you borrow short-term 30, 60, 90 days. Well, this market was drying up. There was buy this type of commercial paper when it was out there. And the Fed, okay, if you have a short-term borrowing that you need 30, 60, or 90 days, the Fed will do it. And so again, they stepped into the market and began lending directly to firms. So again, this is something that the Fed has never done before. Its actions are always indirect. Now we're seeing the Fed be a direct lender to firms. The Main Street Lending Program and the Paycheck Protection Program facility are things I discussed. These were implementing those policies under the fiscal policy of getting funds out to make sure that firms can maintain employment and maintain their payroll. So I've gone almost as long as I should. I'll skip over that. One big question that keeps coming up is how do we pay for this? Simple answer is, look, we weren't on very good grounds before in terms where the U.S. debt was. The deficit was at 4.9% or forecast to be. Now it's 10%. Good news is Treasury interest rates are near zero. Another way to think of it, look, again, this comes a matter of trade-offs. What we're really trying to do now is these actions, we're trying to save lives and maintain unemployment. And then we will worry about the debt deficit later. Again, it can potentially have problems, and there will be an exit strategy. So economists and I think politicians worry about this. But I think what we want to do now is move beyond the health crisis, get the economy back and running as best we can. So quickly, I kind of showed what the economic forecasts were. Let me end with something. There's a concern now about lifting the shelter in place. So one thing is I've been more or less in favor of the shelter in place. And one of the reasons is, one, we don't know much about the transmission mechanism. We have differing views of the health risks. And what I think the policy does, or fiscal policy does, it helps coordinate activities between firm owners, employees, and customers. And again, if we can use these shelter in place to again move beyond the health crisis, we'll recover much faster after the shelter in place are lifted. But an important thing I want to emphasize is even before shelter in place were implemented, the private markets were already reacting and basically sheltering in place already. I had a couple conferences that were to be held in Clemson. We canceled those in early March. South by Southwest was canceled. March Madness was canceled. Cato canceled some things. The Boston Marathon, Kentucky Derby, all of these things were canceled without shelter in place. So again, the idea here is markets in many ways will shelter in place naturally. I don't want to get sick, so I'm not going to go out. I don't want to make my customers, employees sick, so I'm going to reduce my economic activity. Another way to see this most dramatically is if you look at all 50 states and look at these are, if you can kind of squint your eyes and see, these are reservations made at Open Table. And Open Table dinner reservations at most restaurants had fallen by 75% roughly, even before shelter in place actions were implemented. So individuals were already sheltering in place. So I think now when we talk about, we're opening the economy up, these are little mini experiments, but remember, if you're a firm, you don't have to open back up. And if I'm a customer, I'm not likely to, I may not decide to go back. So I know in Georgia, for example, stayed close to us, the dentist office are open. I may wait, a couple months, maybe 6, 8 months, a year before I go in to get my teeth cleaned, just because I don't want to take on the risk. And you can think of other activities, tattoo parlors. There may not be a big rush to go back and get tattoos until the health crisis is. Just because we're allowing something to be open doesn't necessarily mean that there's going to be a big rush in demand or a big rush in supply. What I think we're going to see is some idea of people's tolerance for risk. If a store opens up, how much will people be willing to come back and go to a retail store, and how will they behave? Will Yelp reviews, for instance, start reporting safety aspects and health aspects? I know I had to go out to the store to pick some things up yesterday or 2 days ago, and I had this, a mental Yelp kind of review of the 2 different stores I went in terms of how they were managing some of potential health issues that may present itself. So that's, again, covering my quick view, though I went nearly an hour, of kind of the economics, how economists have thought about COVID-19. So let me switch out of this screen share if I can, and then we'll take some questions. Ted or Debbie, do you want to ask the questions, or?
Yeah, great. That's a great presentation, Scott. Very in-depth. Certainly appreciate it. You definitely sparked a lot of questions. Our Q&A is full. Obviously can't get to all of them, but one of the first questions we have is from Mike, and Mike is asking if there is an autumn reoccurrence of the outbreak, how will the economic impact compare to what we have seen so far?
Yeah, so that's a great question. That's a big concern. In some 2 ways, again, depends on how quickly things spread, obviously. So how big the outbreak is. A second thing is, I think everybody now is going to be a little bit more prepared in terms of business continuity plans, household continuity plans. So I think we could be in better shape. I know some firms and some individuals are talking about, if there's an outbreak in the fall, that we hope that with a 2 or 3 week short shutdown, then we could quickly move again and then ease back into it. So again, I think we do worry about it spiking back up, but I think hopefully we've learned our lesson, learned some important lessons, just like we learned coming out of the financial crisis.
Great. Thank you, Scott. Now, John asked the question, he says, is a recession a good term to use to describe this event? Since this isn't a normal business cycle event, but instead a government mandated shutdown of the economy?
Yeah, so that's a great question. It is a recession in terms of all of our technical definitions of what the NBER would call a recession, right? It's a decrease in economic activity, widespread across wide swath of industries, employment falls, less pressure on prices. So a technical definition, yes, it's a recession. But in many ways, this is right. It is in some ways it's mandated by the government, but I would also make an argument that you could see from that open table graph. Even if everything wasn't mandated by the government, I think most individuals would be very leery about going out and undertaking all the activities they were before. It's not clear when I'm ready to go back and watch a Clemson football game with 86,000 people. So again, I think we would see some type of cessation of economic activity or decrease in economic activity, even if it wasn't government mandated. John's right. I think it's a good point. This is one of the clearest examples of a large demand shock that's really halted the economy with very small supply side factors.
Great, Scott, great. Linda asks this following question. Is COVID-19 a case study for the need for global trade or for self-sufficiency?
Yeah, I think a lot of people have asked that question. I think the better, how I would think about it is we should have, not necessarily about global trade, but we had plenty of warning signs with MERS and SARS that a pandemic was around the corner. I think governments, households, and firms did a terrible job of preparing, having any type of plan of action to prepare for that. So I think anything that the takeaway from this is going to be more on the what is our state of preparedness. So we've gone through 10 years of an economic boom, and it's really surprising. There are many reasons, several different reasons, but why firms didn't have funds set aside, why households didn't, and why governments didn't. So what I think is what we should have going forward is a better preparedness plan for these type of pandemics.
Okay, great. And one last question for you, Scott, before you go. And the question is from Anne. And Anne asks, why do we trust the stock market as a forward-looking predictor when it so clearly responds irrationally to events? Got to unmute, Scott.
Maybe it would have all been better that way. No, so I think really, yes, so the stock market can, from day to day, overreact, but if you look at trends over the course of weeks, months, and years, it really does correlate with what is coming down, what's coming down the road. So yes, there can be an overreaction on any day, pick a few days, but when you look at, just general trends, I think there is a fairly strong correlation between stock market movements in the stock market and economic activity. And again, so another way to also a little bit differently, given the limited data availability that we have to show how COVID was impacting the economy, the stock market is a real-time forecaster of that. And so again, that's another reason why it's used, other than just being forward-looking. It's something that we have in real time that's measuring some type of market response. Great question.
All right, great. Thank you so much, Professor Baier, and for your time, and for everyone else for listening and participating in today's webinar. Just as a quick reminder, please take a moment to give us your feedback on the brief follow-up survey. And of course, stay safe and healthy and have a great afternoon or evening, no matter where you are. Thank you very much.
And again, I want to thank everybody for taking time out of their afternoon and evening for this. So, and I appreciate Ted and the people at FTE putting this on. Thank you.
All right.